Tilray Brands is a stock defined by its volatility and its direct exposure to the evolving landscape of cannabis regulation. As of the latest market updates, TLRY is trading around the 1.35 mark, a price that has been on a roller coaster ride. We've seen a significant surge in recent weeks, with the stock jumping over 16% on a single day and over 42% in the last 6 months. This surge is not a random event. It's a direct response to a major potential catalyst that has swept through the entire cannabis sector: the prospect of a significant federal policy shift in the United States. Specifically, the U.S. government is considering reclassifying marijuana from a Schedule I drug to a Schedule III drug. For companies like Tilray, this is the most significant news in years. A reclassification could drastically reduce federal restrictions, ease banking and tax burdens, and open new avenues for medical cannabis access. This regulatory momentum is the primary engine driving current investor interest and the recent price appreciation. It's a high-stakes bet on legislative change, and for Tilray, a Canadian company with a growing global footprint, the implications are profound. Financial health and performance. A closer look at the numbers. To understand Tilray, you have to look beyond the stock chart and into its financial statements. The company reported its Q4 and fiscal 2025 results in late July, and the numbers present a complex picture. Revenue. The company achieved record annual revenue of $821.3 million in fiscal 2025, a 4% increase year over year. On a constant currency basis, the growth was even stronger at 6%, hitting $834 million. This growth is largely a result of strategic acquisitions in the international cannabis and beverage sectors. The cannabis segment itself contributed 30% of total net revenue for the year, with a notable 71% growth in international cannabis revenue in Q4. Segment diversification. Tilray is no longer just a cannabis company. Its revenue streams are diversified across 4 main segments: cannabis, 30%, beverages, 29%, distribution, 33%, and wellness, 8%. The beverage segment, which includes acquisitions from Anheuser-Busch, has been a key driver of overall revenue, though Q4 saw a decline in this area due to industry-wide softness and other factors. Profitability challenges. This is where the story becomes more complicated. Despite the top-line growth, Tilray continues to struggle with profitability. The company has a negative operating margin and a very poor net income margin. This indicates significant operational inefficiencies and a struggle to manage costs. The earnings per share, EPS, for the fiscal year was a negative 2.46. While gross margins have shown improvement, particularly in the cannabis segment, the path to a profitable bottom line is still long. Strategic moves and market positioning. Tilray's strategy is clear: expand globally, diversify its product portfolio, and position itself for future regulatory changes. The company's recent moves are a testament to this approach. European expansion. Tilray is aggressively expanding its European presence. The recent strategic partnership with Molteni, an Italian pharmaceutical firm, is designed to broaden the availability of Tilray's medical cannabis extracts in Italy. This is a crucial move to capture market share in a burgeoning and regulated medical cannabis market. Tilray is already a major player in countries like Germany, Portugal, Poland, and the United Kingdom. Acquisitions and brand building. The company has used acquisitions to build a formidable portfolio of brands. Beyond its cannabis brands like Afria and Broken Coast, it has amassed a significant presence in the craft beer and beverage sector. This includes popular names like Sweetwater Brewing Company and Shock Top. These acquisitions are not just about revenue diversification. They also provide potential distribution networks and brand recognition that could be leveraged if and when cannabis regulations loosen. NASDAQ listing and compliance. A critical point of concern for investors has been Tilray's stock price trading below the 1 minimum required by NASDAQ for continued listing. The company has applied for an extension to address this issue and is exploring options, including a potential reverse stock split. This is a non-trivial matter that requires shareholder approval and could impact the stock's future trajectory. It's a key risk factor that should be on every investor's radar. Analyst sentiment and future outlook. The consensus among analysts on Tilray is a hold. This reflects a divided opinion and the inherent uncertainty in the cannabis sector. While some analysts maintain a buy rating, a significant portion recommends holding or even selling. Price targets. Analyst price targets are varied. Jefferies recently raised its price target to 2 from 1.5, citing the potential benefits from U.S. regulatory changes. However, other analysts have a more cautious view. with some targets averaging around 0.93. This discrepancy highlights the speculative nature of the stock. The forward P/E ratio stands at 18.5, which suggests that analysts and the market are pricing in significant future earnings growth, even though the company is currently unprofitable. Growth forecasts. The future growth forecasts for Tilray are optimistic on the top line but remain a concern for profitability. Analysts predict a strong surge in earnings and revenue growth in the coming years, with earnings per share expected to grow by over 100% per annum. However, the company is still forecast to remain unprofitable for the next few years. This disconnect between revenue growth and profitability is the central dilemma for investors. The risk-reward equation. Investing in Tilray is not for the faint of heart. It is a high-risk, high-reward proposition. Risks. Regulatory uncertainty. The biggest risk is that the anticipated U.S. cannabis reclassification does not happen or is delayed. This could remove the primary catalyst driving the stock and lead to a significant sell-off. Profitability issues. Despite revenue growth, the company's persistent unprofitability and operational challenges are a major concern. Share dilution. Tilray has a history of issuing new shares, which can dilute existing shareholder value. NASDAQ delisting. The ongoing risk of non-compliance with NASDAQ's minimum share price could lead to a delisting, which would severely impact the stock's liquidity and investor confidence. Intense competition. The cannabis market is highly competitive, with a number of well-funded players vying for market share. Rewards. Regulatory tailwinds. The potential reclassification of cannabis in the U.S. is a monumental opportunity. If it happens, Tilray, with its established infrastructure and brand portfolio, is well positioned to capitalize on a massive new market. Global leadership. Tilray is already one of the largest global cannabis companies. Its international footprint provides a buffer against the regulatory uncertainties of any single market. Diversified business model. The company's expansion into beverages and wellness provides alternative revenue streams that can help stabilize its business while the cannabis market matures. Strong balance sheet. Tilray maintains a strong liquidity position with current assets exceeding short-term obligations. This gives it the financial flexibility to pursue strategic initiatives. Conclusion. A calculated gamble on the future. In summary, Tilray is a company in transition. It has successfully grown its top line and diversified its business, but it has yet to prove it can consistently turn a profit. The stock's performance is currently being driven by speculation around a potential U.S. policy shift. For a prospective investor, the decision to buy, hold, or sell is a calculated gamble. If you are a risk-tolerant investor with a long-term horizon and a strong conviction that federal cannabis reform in the U.S. is imminent, Tilray presents a compelling opportunity. Its established international presence and diversified portfolio give it a unique position to capitalize on a rapidly expanding market. However, if you are a risk-averse investor, the company's unprofitability and the significant risks associated with regulatory uncertainty and potential share dilution are major red flags. The wise investor will keep a close eye on a few key metrics: the company's progress on profitability, the status of its NASDAQ listing, and, most importantly, any concrete developments from Washington, D.C. The future of Tilray stock is not just a function of its business performance.